So today I just wanted to hop on here and talk a little bit about down payments and LTV, what they are, what is required on some of the different loan types, and that kind of ties into mortgage insurance, PMI or MI, what's required, those kinds of things. So wanted to start with down payments. Depends on your loan type and um, a few other factors, what you're going to be required to do. So FHA is 3.5% minimum. It's always going to be that 3.5% minimum. And that doesn't matter if you're a first time home buyer or not for that program. That is just a primary residence program. So if this new home that you're going to be purchasing is a home that you're going to be living in, then you automatically would be required to bring at least 3.5%. That is also what is called your minimum required investment in that loan. So even if you are getting seller concessions and things like that, you still have to bring at least that 3.5%. Now, conventional is a little bit different. So conventional is anywhere from 3% or more. There are certain programs that will let you bring 3% if you're a first-time home buyer. Some, it doesn't matter. And then there are some that have income restrictions with that as well. If you don't qualify for those, the next step would be 5%. But it is no longer a minimum of 20% or more. And I know that used to be a pretty big standard, but it is not required at this point. So you can put 20% down if you have that availability, and there are some options that kind of come along with that and what that can kind of change for you. So say you have more than 20% down, you can cover that down payment and you have additional to cover your closing costs and everything, no problem. What does that do for you? So one of those big things is if you put 20% down, you don't have to worry about paying private mortgage insurance. Whereas like FHA, that is automatically included and it's based off of a percentage instead of like a flat fee. Where on the conventional side, you have mortgage insurance companies that will actually provide you quotes based on your credit profile, what your DTI is, things like that. So it can, depending on where your credit rating is at, it could benefit you to go that route. When you're looking at like USDA, that is a zero down program, but that is also a rural development loan. So there are going to be some restrictions on not only your credit profile and whether you qualify for that, but is the home that you're interested in an area that qualifies. Super easy to find that out. You can actually go online, and if you just Google USDA eligibility map, you can go in and type in those addresses and kind of see where some of those boundaries are. That's also something that you can ask your lender or realtor to kind of go over with you to see if you qualify for those. With that being said, each of these programs also has a minimum credit score. So FHA, their minimum credit score is 580. Conventional for us, we are at a 620. USDA and VA are also at 580, but they can have additional requirements. So with that being said, and what I mean by that is every loan we have to get everything in the system, get everything reviewed. We make sure you meet the basic minimum requirements, and then we have to run that through an automated underwriting system. And that will tell us if you are, based on those parameters and everything that's been entered, if you are qualified for that loan. Obviously, there's some more steps that has to be reviewed by an underwriter, but that gives us that automatic, okay, yeah, we have something here. This is going to work. Each of those, it's going to look a little bit deeper. It's going to look at not just your credit score, but your full credit profile. It's going to look at how much you have in assets, things like that. So when it comes to USDA, they look a little bit further. They're looking at everything that everybody else is, but then they're also looking at the home and the address and making sure all of that qualifies. So all of that to say that there are a lot of layers to that. And finally, I wanted to bring up manual underwriting, what that is, and when we can do that. So most of the time we see that with FHA, but we do that on VA and USDA as well. Kind of depends on the area, how much you're going to see of each of those. But those are basically when we run that loan file through that automated underwriting system, if we're not getting an approval, then we can look at subsequent guidelines to see if maybe we can do a manual underwrite and get approval through the underwriter to still get you qualified. So like I said, FHA is the one that I see that on the most. We do quite a bit of those, but then they go in a little bit deeper and they're looking at your payment history and, how many late payments you may have had within the last 2 years and different things like that. So that's kind of a second tier, some additional things that we can look at to still try to get you qualified. Just kind of a basic overview, not a deep dive, but if you have more questions and you want to get some more information on that, I'd be happy to go more in depth on that. Again, last thing, with your down payment, I know I brought up LTV at the very beginning, and a lot of people may not know what that is, but that's your loan to value. So say you have really any purchase price, it doesn't matter. But if that's 100%, whatever that purchase price is, that's considered your 100%. So say you're putting 5% down, that brings it down to 95%. That 95% is your LTV or loan to value. And each of these programs has a maximum. Really, it's the inverse of one or the other. So again, if you have questions, please reach out. I'd be happy to clarify or go more in depth on any of these things. Have a great day.